Here to address it all is Citi Wealth CIO Kate Moore, and welcome. Thanks for coming by.
Yeah, great to be here.
So, yeah, we have a lot to kick around here. First of all, does it make sense that the equity market is so sensitive in the moment to these moves in treasuries? And describe this feedback loop.
Look, it's been uncomfortable for me, I'd say, for the last couple of weeks, and we've been neutral on equities for a while at this point, to see equities grind higher on no positive fundamental news and no positive macro news. We're at a time when revision ratios are negative. Yes, there was some strength in corporate earnings that's backward looking and, frankly, really concentrated in tech and comms and not a really kind of broad-based earnings story. And we're seeing these cracks in the economy and the consumer slowing down, obviously the forward challenges around policy, trade, and tariffs. And I was a little uncomfortable with the market moving higher on all of these kind of technical factors. Today feels like everyone's kind of waking up, that the breadth in the market is narrower, frankly, than many people wanted. I want to get to a place where I'm excited about talking about adding equity risk, but I'm just not there yet.
The breadth in the market, interestingly, depending on how you measure it, is actually one of the upside attributes, I thought, right? If you look at the technical stuff, it's like you look at the cumulative advanced decline, you look at the percentage of stocks that just shot above some moving average, and everyone said, okay, that's escape velocity from the lows of April 7th. Why is that not the case?
Well, I'm talking about the breadth in earnings. Maybe I should have specified there.
Perfect, yeah.
So the breadth in the price movement was really strong, but the breadth in earnings, especially forward earnings revisions, was really, really narrow. In fact, when you look at the aggregate earnings revision ratios, they're pretty low, many more cuts than there were upgrades. At the same time, the only places you were seeing upgrades were in tech and comms. And that's what I'm really talking about, is that most of the earnings are coming from these really concentrated places, and yet the entire market was rallying as if we're going into an expansion.
That is, I guess that's true, although it was a round trip, right? We started up here. You plunged over the course of 7 weeks, almost 20%. And I guess that the bull case had been, whatever you think about where tariffs ultimately settle, we rolled back from the brink of the maximum pressure. You probably have to lower recession probabilities from what they would have been otherwise after the China deal. And even the bond market seemed to be saying, okay, we can price out the imminent recession risk. The credit markets are fine. And therefore, stocks were just catching up to that view.
Yeah, well, this is how I'm putting it to our clients. You know, we've been past this point of maximum tariff shock, but not anywhere close past the point of tariff pain. In fact, we haven't even really felt it yet. So, yeah, we've had this incredible round trip in terms of risk assets. People have been more sanguine. They put risk back on. But that wasn't broad-based, right? We saw some segments of the investment community stay more on the sidelines or hold their allocations. And frankly, at Citi Wealth, we've been on that camp, too, where we've been more neutral equities, rotating into the higher quality parts of the equity market. What I will say is this, because we have not felt pain yet, I'm still curious to see if people will look through what we know is going to be an air pocket in terms of activity over the next couple of quarters and just say 2026 might be okay because we're not going to have 40% tariffs across the board.
Right.
Or, you know, are people going to say, hey, look, there's going to be more durable threat to the margins of U.S. corporates, and so we want to stay really concentrated in the high free cash, high quality companies.
Yeah, there has been this maybe one line of thinking that says you kind of get a free pass here a little bit on the data, you know, for a couple of months, however long it might be, where the stakes are a little bit lower because maybe you think tariffs are going to get better. The other piece of it, though, and this has probably been the key, is that big money positioning was deeply negative in early April, probably was slow to rebuild exposure. To whatever degree they're now chasing it or have chased it, we're left with a little bit less of a tailwind from that.
Yeah, a little bit less of a tailwind. People have re-risked. You know, there are three big segments, as we know. There's the institutional, there's kind of the long-term asset allocation folks who didn't make many changes, and then there's retail, who've been all over the map. And on the institutional side, you've seen kind of the fast money, the hedge fund community, move pretty aggressively. But I will say the real money, kind of the mutual fund investors, were maybe picking up shares of stuff they liked when things got really beaten down, but we're not aggressively adding to risk. I mean, everyone is, before all this tariff stuff started, was asking the same question. How sustainable is the U.S. equity market outperformance after these last 2 years? I have to say, I think in the medium term, it is sustainable because of higher quality companies. But there was a lot of doubt, frankly, around allocations. And people were not really willing to jump in and sort of back the truck up.
Right. And even aside from those mutual fund investors, you had another segment of retail which has never quit, which is the kind of high-frequency trader types. Kate, stick with me here. We're following, of course, a developing story out of the White House.